Imagine it is October 1930. You are a grain farmer living in rural Nebraska, a man who has spent 3 decades working the same soil season after season. Your name is Harold, and the land has always rewarded patience, discipline, and hard labor. Last month you sold your harvest and deposited $4,200 into the First National Bank in your small town. That money represents an entire year of sweat, sunburn, and long days behind a plow. It is meant to buy seed for next spring and food for your family during the winter months, when the fields sleep under cold skies. On a quiet Tuesday morning, you hitch your truck and drive into town planning to withdraw $80 for supplies. As you approach the bank, something feels wrong. A long line stretches down the sidewalk. Neighbors whisper nervously while others shout in frustration. The doors are locked. A piece of paper taped to the glass reads, "Close until further notice." You push toward the entrance and knock. Inside, a bank clerk briefly looks at you, then shakes his head and walks away. Your money is still in that building, sitting somewhere behind steel and concrete, yet suddenly it is unreachable. The realization spreads slowly but painfully. The savings you trusted to the bank are gone, not stolen by a thief, not lost at a gambling table, but erased by the collapse of the institution meant to protect it. In the early 1930s, thousands of similar stories unfolded across the United States. Within just a few years, nearly 9,000 banks would fail. Entire communities watched their life savings disappear overnight. Families who believed their money was secure learned a devastating lesson about the fragility of financial systems and the difference between believing something is safe and understanding how it truly works. What makes this history important today is that the structural foundation that allowed those events to happen never completely disappeared. It evolved, changed names, and gained new regulations, but the core architecture still exists. Most people assume that when they deposit money in a bank, it simply sits there waiting for them. The building looks strong, the vault appears secure, and the system feels reliable. Decades of messaging and convenience reinforce the belief that the money is stored safely until you decide to withdraw it. The reality is more complex and far less intuitive. When you deposit money into a bank account, you are not storing your cash in a personal vault. Legally speaking, you are lending your money to the bank. The institution records your deposit as a liability, meaning it owes you that amount in the future. But the cash itself becomes part of the bank's assets. It can be lent to other customers, invested in financial markets, or used in various transactions that generate profit for the institution. Most people never notice this arrangement because the system functions smoothly most of the time. You swipe your card, transfer funds online, or withdraw cash from an ATM without thinking about the mechanics behind those actions. The constant availability of digital balances creates the impression of ownership. Yet there's a subtle difference between having access to funds and truly controlling them. Access can be limited or frozen under certain circumstances, especially during moments when financial institutions face serious stress. The banking system operates under a model known as fractional reserve banking. Under this system, banks keep only a small portion of deposited money available as reserves while lending the rest to borrowers. For example, if someone deposits $1,000, the bank might keep only a fraction of that amount and lend the remainder to another customer. That borrower spends the money, which then becomes another deposit somewhere else in the banking system, continuing the cycle of lending and redepositing. Through this repeating process, the original deposit can support many times its value in total credit throughout the financial system. Economists call this the money multiplier effect. It allows banks to expand lending and stimulate economic activity by creating credit far beyond the physical cash originally deposited. In stable times, this structure helps businesses grow, homeowners finance property, and economies expand. However, it also introduces a delicate imbalance that depends heavily on trust and confidence. The vulnerability appears when many depositors attempt to withdraw their funds simultaneously. Because banks lend out most of the deposited money, they cannot instantly repay every customer at the same time. Loans are typically long-term, while deposits are available on demand. This difference in timing creates what financial experts call a maturity mismatch. As long as withdrawals occur gradually, the system functions. But if confidence suddenly disappears, the imbalance becomes dangerously visible. During the early years of the Great Depression, this weakness spread rapidly. News of failing banks triggered fear among depositors who rushed to withdraw their savings before the doors closed. Unfortunately, these actions often caused the very collapse they feared. When enough customers demanded their money at once, banks quickly exhausted their limited reserves. Institutions that had seemed stable for decades suddenly became insolvent, leaving communities without access to their own savings. To restore confidence after the crisis, the United States created a government agency called the Federal Deposit Insurance Corporation. Its purpose was to insure bank deposits up to a certain limit, so that ordinary savers would not lose everything if a bank failed. Today, that insurance covers deposits up to $250,000 per account holder at insured banks. For many people, this protection provides reassurance that their savings are safe within the banking system. However, deposit insurance has practical limitations that are rarely discussed. The insurance fund itself holds only a fraction of the total deposits it guarantees. It is designed to handle isolated bank failures rather than a widespread collapse of multiple institutions at once. If several large banks encountered severe problems simultaneously, the government would likely need to intervene with additional support, creating money or borrowing funds to stabilize the system. Events in recent years have reminded observers that banking stress can still emerge quickly. When certain financial institutions experience sudden withdrawals from nervous customers, regulators and central banks stepped in to prevent broader panic. Emergency lending programs and special guarantees were created to stabilize confidence. These actions demonstrated the system's ability to respond to crises, but also revealed how rapidly trust can evaporate in a digital banking environment. Different countries have faced similar challenges. In some financial crises, governments have frozen bank accounts, limited withdrawals, or converted deposits into other financial instruments in order to stabilize failing banks. These measures are controversial but illustrate how authorities sometimes distribute losses among creditors and depositors rather than relying entirely on taxpayer-funded bailouts. Such policies highlight the complicated balance between protecting savers and maintaining the stability of financial institutions. Because every financial structure carries risk, people throughout history have explored various ways to protect their wealth. Some hold physical cash outside the banking system to ensure immediate access during emergencies. Others purchase government bonds, which represent loans to national governments rather than private banks. Precious metals such as gold have served for centuries as stores of value independent of banking institutions. Each of these approaches comes with advantages and drawbacks. Cash can be stolen or lose value during inflation. Government bonds depend on the financial strength of the issuing nation. Precious metals require secure storage and may fluctuate in price. Real assets such as land or property provide long-term stability but lack the liquidity of cash or digital balances. There is no single perfect method that eliminates all financial risk. The deeper lesson from historical crises is not that banks are inherently dangerous, but that financial systems are complex machines shaped by incentives, regulations, and human behavior. They function remarkably well during stable periods, facilitating trade, investment, and economic growth. Yet, like any complex machine, they can malfunction under extreme pressure when confidence disappears or when underlying weaknesses become visible. History shows that individuals who understand these structures tend to navigate crises more successfully than those who assume the system will always function perfectly. Awareness encourages diversification, careful planning, and thoughtful questions about where money is held and how it is protected. Preparation does not require predicting the exact moment of a crisis, only recognizing that uncertainty is a permanent feature of financial life. When Harold stood outside that small bank in Nebraska, staring through the glass at the vault that held his vanished savings, he was experiencing a lesson that millions of people would learn during the Great Depression. The doors were closed, the system had failed, and the rules suddenly mattered more than expectations. Understanding those rules today allows modern savers to view the financial world with clearer eyes and a deeper appreciation for how the system truly operates.